Welcome to FI 630, and today we'll be discussing Chapter 1, Overview of Financial Management and Financial Environment. And again, today will be a sort of a precursor on the topics we'll be discussing. You know, I know some of you may have had a finance course recently, like you, or probably you've had a finance course maybe several years back, but you've been in profession. So, you know, and students online, I can see 2 students who have joined in. They probably may have had a finance course sometime back. So in any case, you know, what we're going to do is we'll proceed with some of the basics of the survey of finance or principles of finance that you probably may have taken recently or sometime back. And then we'll move on to discussing the topics which lay ahead of us, you know, in this semester. So let's then proceed with this chapter, and the topics in the chapter would be discussing forms of business organizations. Again, that's a very basic discussion, nevertheless important. Objectives of the firm, which is to maximize shareholder wealth, determinants of fundamental value, financial securities, markets, and institutions. And towards the end, there's going to be a discussion on the recent financial crisis, you know, just to demonstrate how important understanding of financial management is. So why is corporate finance important to all managers? I mean, when we talk about financial management, in some universities you'd find this course listed as corporate finance, some universities would list as financial management. Both are pretty much the same. So corporate finance provides a skill managers need to identify and select the corporate strategies and individual projects that add value to their firm. So what is meant by that? Why is it so important to select projects which add value to the firm? That will increase the assets, yes, but the underlying, you know, the shareholder wealth. We're talking in context of you know, publicly listed firms per se, and the projects which will add to the value of the firm and the shareholder wealth could be partners also. I mean, something that's going to add value is why it's important to understand financial management, because even if you look at companies like Google, Microsoft, they may have you know, hundreds of billions of dollars in cash reserves or in assets, but yet their resources are limited. You know, they can't just indefinitely keep buying small companies or putting money in projects which may not be fruitful in the end. So even those companies are quite prudent. And look about small businesses. Small businesses have to be even more careful when getting into a new venture or expanding or you know, even starting something new. Why? Because of the whole concept of liquidity. That is the cash flow, you know, how the money is going to come in, how money is going to go out, the management of cash flow. All those things are important. I mean, in the recent financial crisis, why the number one reason, and still is, why small businesses primarily fail is because of the cash flow management. It's not that the product is bad. It's not that the promoters have not put in enough expertise or they've not put in enough hours of labor. It's sometimes a lack of understanding of topics such as the cash flow, which would hurt a company. I keep giving example of the General Motors. I keep giving example of General Motors. In 2008, the company which had billions of dollars in assets, it had huge inventory. What was the primary reason that General Motors had to file for bankruptcy? Is because of the cash flow. Even though they had, you know, hundreds of $millions worth of inventory in terms of trucks, cars, and SUVs, they were not selling because of the financial downturn and no cash was coming in. So while you have a huge inventory and that looks good on your balance sheet, it doesn't translate into something as simple as cash flow, which is required for payments to be made to vendors, salaries have to be paid, utility bills have to be paid, the interest or the coupon payment on the bonds that the company has issued, that has to be paid. So all those things led to the financial troubles for General Motors. And that was a key thing that possibly the financial managers at GM didn't really think about when they were concentrating on those, big ticket items like the SUVs or the trucks that did provide GM with huge, revenue share, because the kind of profit margins that were being made on SUVs, trucks, and these big vehicles, that was definitely more. But GM didn't realize that the market for those kind of vehicles was shrinking, and they did not diversify into the mass demand products, which were the fuel economy linked vehicles, smaller cars, and so forth. So all these topics we'll be discussing throughout the semester with some examples as we discuss the topics. The other important thing is about forecasting the funding requirements, as I've been mentioning, of the company, and devise strategies for acquiring those funds. Right? Now, one thing that I'm going to keep recurring, reference to is going to be Apple. Apple, I think, is perhaps one of the most successful companies of recent times. Why is that? Why has Apple been successful? Obviously, they have a great product. They started out with, the iPod, and then the iPhone, and then they came with the iPad, and other products that they have revamped. But what has driven Apple to succeed is primarily innovation. Yes, they're providing something to the market which nobody else had provided. I mean, even though now other manufacturers have been able to catch up Apple, but for almost 7-8 years there was no competition to Apple, so they could demand the kind of profit margins that they wanted. They could literally demand how and where they're going to be selling their products. I mean, iPhone was exclusive to AT&T. They were demanding a revenue share by with AT&T. So could any other company demand that? No. It was Apple which revolutionized the whole concept of innovation and providing products which could generate those extra value to the company. So again, think about those topics as we discuss the other aspects in this course. So business organizations from startup to a major corporation. If you look at any major corporation around us, Apple being one, or Microsoft, or Samsung. Yes, Samsung also started small. All these companies started small. They started as a sole proprietorship. Somebody, started the company probably with their own savings or from their friends and family. They probably had a friend or a family member who started the business together. So this started as a sole proprietorship, and then they moved on to partnership and then corporations, right? So this is basically the cyclical trend of how companies have progressed in business cycle. So talking about proprietorship, what are the advantages? Obviously, it's the ease of formation. If you're passionate about a product, it doesn't take a whole lot to really start a business as a sole proprietor, because it's subject to few regulations. No corporate income tax, because everything that is generated as net income is taxed as at the personal income tax level. So that is the ease of starting a proprietorship. Disadvantages obviously is the limited life. Why is that? I mean, I may be passionate about a coffee shop that I may have opened, but would my, kids be as passionate? Maybe or maybe not. Or some family member, maybe or maybe not. So what am I going to do, once I think about retirement? Maybe I'll have to sell the business to someone or just close it, right? So it's got a limited life, possibility of a limited life. There is unlimited liability. What that means is any creditors, dues is possibly can be attached to my own assets, because it is a sort of a sole proprietorship. Now there are ways to insulate your risks by setting it up as an LLC, limited liability corporation, but that again is treading into a sort of a partnership. Then there is a difficulty to raise capital to support growth. I mean, again, I may have a great product. I know my product would be successful, but banks, investors, they may not realize the same passion that I may have for the business. For example, we've heard stories about Steve Jobs or Michael Dell. They all had difficulties in the initial part of setting up a business because they had money, from their savings, but nobody else wanted to invest. So it took them a long time to really bring market on board, from investors, private investors, angel investors, to really know about their product and then invest in the product. It was especially difficult for, you can imagine about, technology. People, even today, wouldn't understand technology a whole lot, right? So you feel a little apprehensive discussing technology or investing in technology. Think about 1970s or 1980s, when the computers were literally, they were like as big as this room, or nobody understood what computers could really do. So imagine Steve Jobs trying to convince investors to come on board to invest in his company. So that is always a difficulty for proprietorship. Starting as or growing into a partnership has roughly the same advantages and disadvantages as a sole proprietorship. In case of partnership, obviously, why would you want to have a partnership? Is to bring on board somebody with expertise, or somebody who has the resources or finances, so that you can expand your business or sort of specialize what you offer in your business. Now we come to the concept of becoming a corporation. A corporation is a legal entity separate from its owners and managers. That's a very important aspect. So a corporation, by its own right, in the eyes of law, is a legal entity. That's a very important concept. Now what you're doing is you're separating the corporation away from its promoters. Now promoters are individuals, and so is the corporation. So what does that mean? Irrespective of whether the promoters come and go, if there's a corporation, the shareholders are the one who own the corporation. So a corporation, if it would want, could exist for an infinite time. It doesn't have to close down its shutters, just because the promoters, died or they no longer want to conduct the business. It's the shareholders who own the corporation, and the corporation will continue until infinite time. That's the reason why, if you recall from the Survey of Finance course, that the dividends that the corporations pay are considered as a special case of a perpetuity. What is perpetuity? As long as you can foresee, you will get a fixed payment in fixed interval for an infinite time. On the other hand, what do you have? Annuity, right? Where you have the payments which are made for a fixed term, for a fixed duration, for a fixed amount. So dividends can sometimes also be taken as a special case of perpetuity. Because what are dividends? They're share of profits, and normally I'll show you when we come to the chapter, companies would be paying dividends which are of equal, almost equal amount at equal time duration for an infinite time. So you'll find that, for example, Microsoft, if it's paying 30 cents a share as a dividend per quarter, they probably would be paying that for last, 5 years, that is 20 quarters and so forth. They normally will increase that if they increase the revenue, but they like to keep it as a fixed, sort of a share of profit for the shareholders to keep them happy. When you become a corporation, obviously it does require the corporation to incorporate with the state and perhaps with the federal regulations. It has to file for charter and bylaws. What are bylaws? Charter, we know it's the permission to operate in a jurisdiction, but what are bylaws? Rules of the corporation, exactly. You can think of it like a constitution of the corporation. That is how the corporation would be governed or would run. And this is becoming a very important topic in finance, which is known as corporate governance. That is how a corporation should be run. So what are the advantages and disadvantages of corporation? As I mentioned, unlimited life. There is easy transfer of ownership. How do you think there is an easy transfer of ownership in corporation? Board of directors are there, but how is it that you can easily transfer ownership in corporation? What represents ownership in a corporation? The share of stock. So if I want to sell my business as a proprietor to you, it takes time, right? I probably will have to go to a lawyer. There'll be some signing of documents. We may have to sign additional documents. There'll be bank transfer of funds, and then depending on it's like buying a house, going through all that paperwork. In case of a corporation, when ownership has to be transferred, it could simply be just selling my shares to you. That's it. I sell my shares on the organized exchange, and you could just buy them, and that's a transfer of ownership. Or I could just sell it to you directly, and have the shares registered in your name. So it's that easy. It's got a limited liability. That's a very important aspect of corporation. Limited liability means the extent of loss that a owner could face is limited to the amount that he or she has invested in the corporation. So just because corporation files for the bankruptcy, the maximum you lose is the amount you've invested in the corporation. Your assets, your personal assets cannot be attached. Ease of raising capital. It probably is going to be relatively easy for Microsoft to issue bonds in the market than if I started a company and issued bonds. I would have to convince market, about my credibility, my product, the viability of my project. Does Microsoft have to do that? No, because they have an established history of operation, they have established products, they have a well-functioning corporation. So it's easier for corporates to raise capital. And what does that mean? With the ease comes favorable cost of capital. If I were to probably take loan in the market, I will get loan at a higher interest rate because they'll try to add, other, different type of risk premiums. For Microsoft, it comes with a favorable interest rate because they have a much lower chance of default. What are the disadvantages? Double taxation. Now this is a characteristic in the U.S. It depends on country to country. It doesn't really mean it's universal, but in the U.S. There is the issue of double taxation. Why do we say double taxation in case of corporations?
Corporations tax on their income, and the owners like dividends,
Exactly. The corporates have to pay because they are a legal entity. They are taxed at corporate tax rate at first instance, and then any net share of profits that the board of directors elect to share with the shareholders is then taxed again at the personal income tax rate that the shareholder would be filing. So that's the whole concept of double taxation. But it doesn't really happen in all countries, like I mentioned. It happens in the U.S., but not in all countries. You have a question?
And is that long enough for corporations to be charity work so they can write off the benefits?
If you ask a corporation, they probably will say no. But but yeah, there are definitely benefits of using funds anyway for charity purposes because it brings a good image to the corporation. Plus, they can obviously write off, as an expense. It'll be tax sheltered, so you won't have to pay tax on that charity work. So, plus, like I said, it does bring prestige to the company because they're doing all the social work and other community-related projects, which I think all companies have started doing. At least the big ones have started doing that. But you're right on point. But if you ask a corporation, they'll say we do it because we we care for the community. So. And then the cost of setup and report filing, because publicly listed companies obviously have to report various financial statements every quarter. They would have to have a number of lawyers and accountants and the CPAs who would be filing all the required paperwork with the SEC. That is important. So that costs money. That's an expense. Plus, with the recent, not so recent, but last 10 years, the addition of Sarbanes-Oxley Act, which adds more paperwork to be filed, that again adds to the whole expense. The companies have been complaining, but to a certain extent, that's a debate because look at what's happened with Enron, WorldCom, all the accounting scandals which have come recently. So though that extra layer of supervisory due diligence is important. But again, that's for debate. Becoming a public corporation and growing afterwards, we have the initial public offering, IPO of a stock. This is to raise cash. Now, in case of a stock, what are you essentially doing? As a corporation, what are you essentially doing? You are inviting more partners for the company. You are selling shares of the company. It's like, if you have, literally, it's if you think of a pizza and you slice it into equal parts, you're basically selling slices of that pizza to more shareholders. So you're inviting more shareholders to become owners of the corporation. And that is done through initial public offering. That's the sale of the share of stocks for the very first time. Can you think of any large corporation that had an IPO recently? Facebook had a very successful IPO recently, I think about 2 years back, and Google had some years back. Why do companies go for IPO? Why not just use the money to expand the business? That's because that is part of the cyclical cycle of the business. The promoters have worked hard. Initial investors have poured in money, and they have taken 5, 10, sometimes 15 years to build a company. Now's the time to make or reap the rewards. So when the IPO is launched in the market, what is really happening is all the shares, because the promoters, they own the shares. Now they're selling their shares and they're collecting money in return. That's why overnight they become billionaires. Most of the people who have been with the company since day one and they've got shares, once those are sold in the market for the very first time, we hear stories about everybody becoming a millionaire, right? I think that was a very interesting article. Anybody and everybody who was with Google when it started had become a millionaire when the company went for its IPO. So, somebody became multi-millionaire, billionaire, obviously, and then somebody who may not be at the ranks of manager or supervisory level, they at least became a millionaire. So, secretaries became millionaire. Everybody became a millionaire because the company itself had such a tremendous value in the market. It allows founders and pre-IPO investors to harvest some of their wealth. This is the whole idea. I mean, why would you want to start a corporation is to ultimately build value for the company and for yourself and your promoters. Subsequent issue of debt and equity. Once the company has its IPO, the company obviously has two ways to raise cash. One is through equity, that is shares, more shares, and the other one is debt, loan. So what is the difference between shares and debt? Borrowing money on one hand and selling shares on the other hand. So what are the advantages and disadvantages? You dilute the ownership, so you are answerable to other owners, right? If I bring more partners to my business, I'm answerable to other owners for my actions. If I take actions for, let's say, buying new machine, other owners might ask, hey, why are you buying a new machine? I may have to justify that. But if I raise money through debt, does the bank or does the debt buyers, do they care how I use the funds? They don't. All they care about is I have to pay them the coupon payment when I promised them, and the principal payment has to be paid back. So depending on how, and it's going to be discussed again through the semester, is we'll have to look at that whole concept of weighted average cost of capital. Again, cost of capital is going to differ. When we raise funds through debt, your cost of capital is usually higher because when you bring on investors, the investors may come on at a cheaper rate just because they're being made partners of the company, and they would see value in the dividends that they'll get to share if the company is profitable. But if you're straight, just giving out loan to a company, you want to see how much of return you're getting in terms of the coupon payment or the interest. All that is going to be discussed in chapters to follow. So that's going to be an interesting chapter later on. Agency problem and corporate governance. We've already discussed about corporate governance. What's agency problem? It's about managers acting in their own interest and not on behalf of owners, that is stockholders. Why would that happen? If we let managers to just work and make decisions on their own, what will happen? They probably may sometimes think about taking decisions that may be to their interest rather than to interest of the company. And that is obvious. If you have a business, you would be passionate about business, right? You probably will even come on weekends and work for the business, but an employee may or may not. You may have a great employee who's as passionate, but more than likely an employee would say, I'm here 8 to 5, I'm probably not coming on the weekend. Corporate governance is a set of rules that control a company's behavior towards its directors, managers, employees, shareholders, creditors, customers, competitors, and community. So it's becoming a big discussion these days, obviously after the recent financial crisis, how a company should ethically behave in a society. I mean, because the company is also part of the society. The corporate governance can help control agency problem. How do you think you can control agency problem? Meetings, yes, but how can you incentivize managers to work for benefit of the company. When you align managers' interest with shareholder interest, right? And we hear about bonuses which are paid out to managers. We hear about all those $1 million CEO perks. There's obviously the stock options. Stock options is a very popular perk where if an employee starts with a company, they're promised a certain number of stocks, but the employee can redeem those stocks after 5 to 8 years. So that basically improves retention with the company, and the employee would work hard to ensure the stock price goes as high as possible, because then the employee can sell those stocks, after 5, 6 years that the company has awarded the employee. So, there are some of these, and then now we hear about technology companies. They come out with all those nice perks about having, they have fancy facilities on campus where they'll provide, gymnasiums or entertainment options. They'll have nice cafeteria. They even can bring kids at work. They give coupons, and they provide all those incentives. They'll have nice parties and everything. So we keep hearing about all those perks that especially the technology companies have been doing for the last several years. Okay, so what should be the management's primary objective? The primary objective should be shareholder wealth maximization, which translates to maximize fundamental stock price. So does it mean that should be the only concern, just to make profit and not think about anything else? And by any means? Obviously not. Companies have to operate ethically. And even though we talk about how companies would shut down manufacturing centers and they'll set up manufacturing centers abroad, and you find several people have been laid off because now jobs have been exported. Is that illegal? It's not illegal. Companies are free to do that, but is it ethical? Probably not. So they probably companies have to find that middle ground where they are obviously working in the bounds of legality, plus also working ethically, or they have a responsibility to their stakeholders. Like I was discussing in my class yesterday in international finance, the viewpoint of corporations differ in different countries. Culturally, in the US, we have a focus that, yes, the main objective of a manager is to maximize shareholder value. In Germany, or most of the European countries, corporates go beyond that. They go beyond shareholders, they go to stakeholders. Stakeholders are employees, community members, vendors. So, for example, a company like GM, if they shut down their manufacturing facility, it doesn't really just end at hurting, the employees who are working at the facility. They're probably going to be, that chain, supply chain. Vendors who are supplying, they're going to be affected. Small businesses are going to be affected. Restaurants, other caterers, all the linked businesses, they're affected. So it's a very large impact when a major manufacturing facility shuts down. But that obviously is part and parcel of the globalization that we are seeing, the trend of globalization where businesses are moving in different countries. So and if we have time, I'll show you a very, very interesting clip that I showed my class yesterday, and then you can think about, how to think about this concept. So do firms have responsibilities to society at large? Yes, shareholders are also members of the society, so they also have to operate ethically. Employment growth is higher in firms that try to maximize the stock price. On average, employment goes up in firms that make managers into owners, such as the leveraged buyout firms. Leveraged buyout firms, they are an interesting case where the corporations which have gone public are again taken back private for the very same reason, because it sort of brings the independence to owners to operate as they want. Can you think of a famous technology company that went private again recently? Yes, Dell is an example. Dell went public, obviously, immensely successful firm, and then recently, 2 years back, they went private again. Why? Because they thought, they won't have to answer to all the shareholders, and now they can operate their strategy based on what they think is best for the company. Firms that were owned by government but that have been sold to private investors. This is the concept of privatization, where government sells its interest in the company over to private individuals. Consumer welfare is higher in capitalist free market economies than in communist or socialist economies. Why is that? Why do you think capitalist system promotes higher consumer welfare than communist or socialist system? Is that a bad thing?
Not a bad thing.
But why does it improve? So why is the consumer welfare better in capitalist economy if everybody is treated equally in socialist and communist system? It's decentralized, yes, and what does that promote? So there is free entry in the market, free exit from the market. So investors are free to choose where to invest, and individuals are free to choose what they want to buy. That creates a market system where the resources of an economy are diverted towards projects which are going to maximize those resources. As an investor, if I'm free to choose where I want to invest based on my own risk perception, I'll be free to choose, within different types of companies, right? So for example, why is Apple successful in the US stock market, or Google is successful in US stock market, or stock market per se? Is because of the revenue generation or the possibility of higher revenue generation that these two companies have demonstrated. US government doesn't tell me where to invest. Or US government doesn't tell me, okay, only 10 companies would operate in IT sector. If that was the case, what would happen? Let's say, for example, if the US government said only 10 companies would operate in the IT sector. So that would mean 10 companies would set up, and then it's a full stop. There'll be no other innovation. There'll be no motivation for innovation, because the 10 companies know, irrespective of what, we will operate. So consumers have choices to buy from only those 10 companies. But look around you. The fact that Apple comes out with new version of an iPhone every 10 months or 12 months is because of the fact that they have competition. They have to. So when we say consumer welfare, it does two things. One is because of competition, it provides the best product to the consumer, and also at the most competitive price. For example, if I feel let's go to let's take a case of a department store like Walmart. I mean, if you go to Walmart and you've got a option between 25 different cereal supply types of cereal box, I can pick what I want based on my own preference and pricing preference. If, for example, Kellogg's brand is they increase the price by 50 cents or $1, that's a different story. If I would just won't even look at anything else because I would just eat Kellogg brand. But if pricing was a criteria, then if Kellogg arbitrarily increased the price, what would happen? Consumers will shift their demand to other products. And that is free in a capitalist environment. In socialist environment, when you have limited suppliers, like a department store, you only have a choice between 2 suppliers, let's say, of cereal, or 1. So what would you do? You would have to buy either one. And both suppliers probably won't have an incentive to provide a better quality and at a cheaper price. Exactly. And is this the best use of resources in an economy? No. Probably if they had gone through the process of innovation, they could have found a better method of providing a better quality at a cheaper price. Look at examples like LCD TVs. When they first came out, or LED TVs, when they first came out, they were in the range of 47-inch or 50-inch. They were in the range of $1,000, $1,200. Within a matter of 1 to 2 years, what happened to the price? It dropped. To a third. You can get a TV at about $300, $400. Why is that possible? Because you got a choice of suppliers or vendors in the range of maybe 40, 50 different type of television models in the same size for different features. So you got an n number of suppliers, and that drives that free market system. So it's very important to understand those basic underlying economic principles as we discuss this financial topics. But it doesn't really mean that there's a commentary. It's a commentary of which system is good or bad. It's basically to understand why one system works and the other one does not. Fortune lists the most admired firms. In addition to high stock returns, these firms have high quality from customers' view, employees who like working there, and consistently firms recently, like IT firms, have been ranked very high because Apple is an admired firm. Everybody likes Apple products. Plus, they also seem to treat their employees well, and they seem to operate in an ethical manner. But Fortune, they list a list. What are 3 aspects of cash flows that affect an investment's value? Amount of expected cash flow, bigger the better. How does that impact the investment value? Mathematically, how would that be true? Does this formula in any? What is this formula? For present value, right? So, if you had to translate this sentence mathematically, this would be the formula. Amount of expected cash flow, what would be expected cash flows here? The future cash flows? If the future cash flows increase, it's directly linked with the present value. So the present value will rise. Well, okay. So this is going to have, obviously, a bigger impact. That's the reason why, what's been happening to the stock market recently? It's been going down. Why is it going down? But primarily, if you are an investor in the stock market, let's say in perception of a company's future cash flows. Exactly. So that scare prompts investors to sell. Why? Because they're thinking that the future cash flows are going to be affected. It probably is going to be a lower future cash flows because there's a slowdown coming again. Companies may not be able to sell products or services as much as we were expecting. So there is a need for market realignment. When the Dow Jones Industrial Average came to almost 18,000, that was with an expectation that everything's going to be fine back again. The Fed was now getting into the process of rising the market interest rates. But suddenly, That's not true. So the drop from 18,000 to 16,000 has happened because of the perception. It's a perception. So two things which are really important when we discuss about financial management per se in terms of financial markets is perception of market participants and the expectation. What are the two things that drive markets? Two human behavior that drive markets. And it's true in all business cycles. Simple two human behavior. Greed and fear, exactly. These are the two things that will drive markets. When you have greed, my friend invested in the stock market and he's made a double profit, so I should get into the market. That led to what? The recent the housing bubble. Why was everyone jumping on to buy a house when we had the recent the real estate bubble? Is because a friend or a family member or I read in the newspaper the kind of returns investors had made by buying a real estate property, so I shouldn't be left behind. I'm going to buy a real estate property myself. Even though a house which was priced at $200,000 a year back is now selling at $700,000, I don't care. I'm going to buy it at $700,000 because it might go to $1 million in a year's time. That's greed. And fear is when investors started dumping properties. So everybody started dumping properties. That happens in the stock market. When there's a sell-off, it basically is happening with that human behavior of fear. Because if we had a magic lamp, if I could see what really is going to happen in 1 year, I would be a multi-millionaire. I wouldn't have to stand here and deliver a lecture. I could just. The timing of cash flow stream, sooner is better. Why is sooner better? Exactly. It's very hard to predict what's going to happen 10 years from now. It's relatively easy to predict what's going to happen in a year's time. So if I get cash sooner, it's better because I can reinvest the cash I'm going to get in a investment which I can turn in for a better return. Risk of cash flow, less risk is better. Again, going with this formula. Where is risk in this formula? This R, which is the required rate of return or discounted risk to the cash flow. This is important to understand. What is this R in relation to future cash flow? It is the probability that that cash flow will not occur. So a higher R means it's a higher risk. A lower R means it's a lower risk. So the US Treasury bonds compared to a stock of a company, would the US Treasury have a higher R or a lower R compared to a stock of a company? A US Treasury bond. The returns on a US Treasury bond, will it have a higher R compared to a US stock? Any corporation stock? It will be lower. Why? Because of the simple relationship. Expected return. Have you seen this graph? And risk. And you've got a linear relationship. So the risk-free rate is the starting point, which is the benchmark rate, of the U.S. Treasury notes or T-bills. Why is it almost zero risk? Why is a U.S. T-bill put here at risk-free rate? Why is it called a risk-free rate? Because it has almost 0% risk. It's backed by the U.S. Treasury, which is backed by the U.S. government. The chances of default are almost zero. There is a chance, but almost zero. Whereas if you look at the returns of a stock, it probably will be somewhere here, where you have a higher risk, but you probably can get a higher expected return. So this relationship is important. So free cash flows, we've just discussed free cash flows are the cash flows that are available or free for distribution to all investors, stockholders, and creditors. The free cash flows are equal to the sales revenue minus operating costs minus operating taxes minus the required investment in operating capital. So we'll cover that in chapter to follow, which is the financial statement. Weighted average cost of capital is the average rate of return required by all of the company's investors. And we call it weighted because this will have two components. One is going to be equity, the other is going to be debt. So weighted average cost of capital is affected by the capital structure, the firm's relative use of debt and equity as source of financing. That is, how much percentage of funding that the firm uses comes from equity and comes from debt. Is higher debt better or higher equity better, relatively speaking? Equity is better, because if a company, let's say, doesn't make profit, can the shareholders take the company to court? I can't take my own company to court, right? I may not have been able to generate revenues, but that doesn't mean I can take my company to court. But debt holders can, because companies signed a legal obligation to provide, a coupon payment and principal payment after the maturity of the bond, right? So if the company doesn't return principal payment or doesn't pay the coupon payment, the bond holders can take company to court, can take legal action. Interest rates. So this is again going to be a major factor in determining whether companies should raise money through equity or through debt. For example, after recent financial crisis, you find that the market interest rates have been almost zero. So any loans which the company has been taking, or any new debt issues that the company has issued, are tied to that market interest rate. Market interest rate is like a building block. It's starting point, then you add other risk premiums. So companies have been able to generate money at a lower rate by issuing debt. That's the reason why we have seen not many companies have come out with new issues, stock reissues in the market, or IPOs have also been just far and few. Facebook was one, maybe some other companies, but not too many. But if the market interest rates start climbing, now probably they may not, it may be delayed, but in several cycles from now, and it's a good thing to observe, as market interest rates start climbing, companies move away from debt instruments and then prefer equity, because their cost of capital is going to be lower in equity than in debt. Because in debt, you'll have to pay a higher interest rate. Because if let's say for example, can get 5% by placing my money in a bank account, the company, when it's issuing new debt, would have to pay higher than that to attract me as an investor, right? And that raises the cost of capital for the company. So these are interesting analogies that you have to observe, and that's the reason why it's important for you to glance over, Wall Street Journal for at least 5 minutes every day to understand how various news in the market impacts, these aspects. And then the risk of firm, we've already discussed, that R component, higher risk. Think of it as the credit rating of an individual. An individual with a good credit score is offered loans at a lower rate. A person with not such a great credit rating has to pay a higher interest rate. Investors' overall attitude towards risk, right after 2007, 2008, nobody wanted to trust investing in the stock market. So obviously, investor perception is also important, and that trust has come back, after several years. So what determines a firm's fundamental or intrinsic value? And we've discussed this. The intrinsic value, what is intrinsic? Just simple English. Inherent, inbuilt. My car, to me, is worth $10,000, but on book it may be just worth $5,000. Or gold is a nice example. Gold has an intrinsic value, which may be $2,000 an ounce, but in market it may be selling at $1,000 an ounce. So it's what you think is the value. Students online, can you hear me? So I was demonstrating, the simple example in class when I got cut off is I just, had this simple pencil in my hand, and I was asking students in class how much would they pay for this pencil. And one student said 5 cents, the other said 5 cents, the third said he doesn't need it, so he's not even going to pay anything. And this is how market is formed. Yeah, so you may think about paying 10 cents for it, or maybe even higher.
Depending upon the grade, if it is 2D or 4D pencils, the price of the grade is more. If it is just HP,
okay,
then it is 5 cents or 2 cents.
Okay. So then now we're getting very technical. But the thing is it's got a razor. So that is something that I want to emphasize is market is formed by many market participants. eBay, for example. Why does one person pay $20 for the same item? Sometimes you find listings which have multiple listings for the same item, and you find pricing different for every listing. Somebody has bought it at $20. Some other person has bought at $20.01. Someone would have bought at $21. Somebody would have bought at $22. It depends on individual's own perception. What you think is the value. What you think is the inherent value. Another simple example is house. When you're in the market to buy a house, you always consider the intrinsic value of the house. For example, if it's listed at $200,000, you'll try to bid down, but you'll bid down to a price which you think is reasonable. And then between 15, 20 different bids, the owner might decide who to go with. For example, I may think the intrinsic value of the house is $150,000. Robert might think it's $175,000. So intrinsic value is the sum of all future expected free cash flows when converted into today's dollars, because you are expecting a future cash flow. This is future. I may think Microsoft is going to make $2 a share in the fourth quarter of 2015. Another analyst might think it's $2.10. Another might think 2.5. So this value is overall market's average value, which is the price at which the stock will sell. When it's undervalued, it sells very fast. For example, if a car is valued on book at $10,000 and it's listed, somebody's parked and said, I'm going to sell it for $7,500, it's probably going to sell, is going to be sold off in a day or two. If it's worth $10,000 and that person probably has customized it the way he liked it or she liked it, but nobody else cares for it, and the person probably spent $20,000 customizing it and now is parked someplace listed at $30,000, nobody will even care. They'll just leave it because the inherent value to another buyer is not the value at which it's listed for selling. So, yeah, go ahead.
Would you say then that's kind of the way how auctions would work?
Exactly. Auctions work similar, in a similar fashion. Market is nothing but auction. You have a simple demand and supply. Wherever the demand crosses supply, it's the market clearing condition. That point is the sale price, the clearing condition, that's the value in the market. Everything in a free market economy simply comes down to this simple relationship between demand and supply. So the determinants of intrinsic value, the big picture, and this is something that we'll be referring to again and again, is looking at how the value of a company or value of a project is impacted by various aspects. So in the case of these future cash flows, they are going to be impacted by expected sales, operating costs, required investment in operating capital, which will translate into future cash flows, and that is divided by the weighted average cost of capital, which is impacted by the market interest rates, the market risk aversion, firm's debt equity mix, and firm's business risk, which will ultimately decide how much money the firm has raised at what cost. So now you can bring almost anything in discussion with a firm in this, expanded sort of a formula. For example, we were discussing about why firms relocate to other countries. Where would you think this would fit in? That is to reduce the operating costs and taxes. Maybe it's cheaper to produce in China. Maybe another country is giving them an incentive to set up shop here so that they'll give them, tax rebate. Many countries do that, and now some states in the U.S. have started doing that. You see ads about New York State doing that. They're inviting companies to come and set up shop there, and they'll give them 10 years tax rebate. That could influence a company to set up their manufacturing facility in the New York State because of tax savings. Ultimately, this will decide the stock price of the company, the market value of the company. What is the difference between the book value and the market value?
So the book value, like you said, say like the auction, a car which may be book value of $2,000, goes to the auction, somebody is trying to sell it, somebody wants it, so he knocks it down in the market like it's a product out.
So that's market value versus book value. Where will the book value of the company come from? From the balance sheet, right? The total asset, less, and then liability side and owner's equity. That is going to bring the book value of the company. Where will the market value come from? From the market participant, that is the share of the firm. Higher the value of the share, more market value of the company. So if, for example, you have the book value of a firm which is greater than the share price or the market value of the firm, is it good or bad in perspective of the firm? It's good to buy, yes, but it's not good for the shareholders because it's not maximizing the shareholder wealth. Because the investment in the company is a lot more, the book value is a lot more than actual share, the market value. So
that's what happens with a lot of the banks.
Exactly. So what the main focus of the managers is to increase the market value of the firm to be greater than the book value. So that, where is the difference coming from? If, for example, all the assets of the firm equal, let's say, $100 million, and all the shares of the firm in the market equal 200 million, where is the 100 million extra coming from? Intrinsic value. That's the market perception, what it is worth to you. It's not how much it's valued on book, but what is it in how much of it is of value to you. So most of the technology firms, you find that if you add all their assets, you add all their furniture and computers or whatever they have, the value of the firm in the market is much higher than the book value. Where is that extra value coming from? It's coming from the intrinsic value, the perception of the market thinking. In long run, the products from these companies will provide us with revenues. For example, Facebook. Facebook's real capital is their website, the Facebook website and what revenue they collect from ads and everything. It's not coming from furniture or buildings or other assets that they own. So exactly, I've got some online students also participating. For example, Natalie says, book value is what is really worth, market value is consumer value, consumer demand. So I think all of us are getting to that whole debate, which is good. Who are the providers, savers, and users, borrowers of the capital? Obviously, when we talk about financial institutions, though that's a complex network of money that transfers in an economy from savers to borrowers. So households would be net savers. They're also the borrowers. They also are the borrowers. Non-financial corporations are net users, which are borrowers. For example, the companies would borrow funds. And it's a very simple, graphically speaking, very simple. You have savers on one end, you have borrowers on the other end, and there are financial institutions which will take funds from savers and pass on to borrowers. And the financial institutions, what they do is they package in various forms and denominations the funds. For example, as a student, you probably want a student loan. Can you go in the market and say, I want $10,000, please give me $10,000? It's going to be very difficult. Probably somebody may have only $1,000. Then you have to search for 10 people to get $10,000 and for a term that you want. For example, if I need a car loan, instead of going to another party, I can just go to a bank and say I want to apply for a car loan and I want a loan. So the financial institutions do this task of providing funds from savers onto the borrowers, and vice versa, because as borrowers pay back interest and principal balance back, that is transferred back to savers. So this complex network of money supply from savers to borrowers is important. Governments, U.S. governments are net borrowers, some foreign governments are net savers. China, we know, Russia, India, they have their foreign currency reserves invested in the U.S. Treasury bonds. So the U.S., I can discuss this forever, but I think we have to look at the time. But I want to discuss another interesting concept, which is debt good or bad? When we talk about the concept of debt, the U.S. government taking debt, is it good or bad?
Yes.
If you can manage it. It's like credit card. For example, if I had to save cash to buy a car or a house, or anybody coming into the market, job market, it will take forever. You take student loan, we take student loan when we are studying, so that we can complete our studies, and then we repay it when we start working, and likewise, purchase of a car or a home. If we had to wait for cash, for a car, maybe you could do it in a couple of years, but for a home, you'll have to wait 15, 20 years, and then you have enough money, you take it to the market and you buy a house. The debt basically provides a facility to pass on, it basically does this intergenerational fund transfers. For example, I take money now as a loan and repay it for a home mortgage over several years. And in return, what do I get? I build equity in my home, that's an investment, plus it gives me the satisfaction of owning a home, for a family. And that is good if I can manage the debt. Same thing is with the US government, is when the US government takes debt, is it good or bad?
It has been good, but it can be bad for the future.
It has been good. How has that been good? You are right on track. Look at the infrastructure projects.
The only thing I can think of,
We benefited from all the uses of the water government.
Exactly. All the borrowed money has benefited in terms of infrastructure, bridges, hospitals, schools. Look at the growth that's happened in the country right after Second World War.
yeah, that's what I was going to say. I was thinking of the war, so the only time I was thinking about it when we borrowed a lot of money, we got into a lot of debt because we were trying to build that couple of years.
Yeah, and that again is how you manage the debt. So coming to the concept, when we talk about the US government, the US Treasury bonds, foreign governments, they are the net savers, they invest in US Treasury bonds. What do those bonds pay in terms of interest rate?
Everything's lower.
To the foreign governments. For example, if China has invested close to $1 trillion in US debt, how much does the Chinese government get by investing those $1 trillion? Maybe less than 1%. Very, very low. Why? Because of, again, the reliability of the debt service that the US government has done since 1945. The US government has never defaulted on its debt. So it can command in world market investors who are willing to buy those bonds at almost 0% or close to 0%. And if that money in turn can help the GDP growth by, let's say, 4 to 5%, so the expense, the cost of capital is 1%, and the GDP growth is, let's say, 4%, so the net benefit to US economy is what, 3%? I would take that any day. If the economy can grow by 3% by this debt, that's debt-financed growth. But it has to be managed growth. For example, if my income is $10,000, and I take debt in tune of $20,000, I know I'm in for trouble because I can't manage it, because my income is half to what my debt level is. So when we came very close to the debt level, which was equal to the GDP 1-to-1, that was the time when the risk signals were really high. The GDP of the US economy is how much? What's the income of the US economy?
A little over 2%, I think.
No, income. What's the dollar amount? May I take a guess?
To what other different terms?
In dollar terms.
One thing you say, I know it takes $2 to make a pound. That's all.
No. What's the overall GDP, gross domestic product of US economy? Close to. I gave the number just a little while ago. Some $1 billion. How many $1 trillion? Take a guess. Higher. It's for $14 trillion, close to $14 trillion. When the amount came close to, the debt amount came close to 14 trillion, that's when there was a scary signal, because now you had the amount of debt that was taken close to the income. So then we saw, all that, policies being made to reduce the debt level. But again, now that we are in MBA level, you have to start thinking about, overall context of, how these issues relate. Somebody said, look, 250 trillion, that's a lot of money. But it's a good guess, Tamika. Which is the second richest country in the world now?
Second.
Yeah.
By what?
GDP, yeah, GDP.
China?
China, yes. What is the GDP close to? 11 trillion. They beat Japan, and now they're coming very close to the U.S. economy. That's pretty much like a personal bankruptcy. When a person files for bankruptcy, what happens? Your credit rating is ruined. Nobody's going to give you debt anymore. If they do, they're probably going to ask you a phenomenal interest rate. That's what's happening to Greece now. No, they're not going to any hyperinflation. Why? Why they cannot go to hyperinflation? Yeah, but Greece can never go into hyperinflation, and you know why? It's because of European Union. It's because of the euro. Because they have euro in place. So when does hyperinflation take place? When the value of the currency devalues to an extent that then you get all the price of goods and services in the economy, the skyrocket. But that will not happen to Greece now because it has euro as a currency of use. So the European Union, the European Central Bank decides how much of money to print and put in the market. So if they don't have enough money in the market to create that hyperinflation, that will never happen. Now we're going into something else, we probably will discuss that. Now Russia is free to decide how much of money they want to print and put in the economy, because it's to be decided by the Russian central bank, whatever it is. Like for example in the U.S., what is the central bank of the U.S.? What is it called? The Federal Reserve. The Federal Reserve has Federal Open Market Committee that looks at the economic health of the country and decides how much of money supply should be put in the economy, and that decides the target market interest rates. So how did the Federal Reserve influence the market to have a lower interest rate? Did it just press a button, or did it just issue circulars or memos to banks saying from tomorrow you have to charge 1% interest? You can't charge more than 1%. How does it do it?
They set the rate that the banks borrow from them.
That's one part, but the main tool for monetary policy is the bond buying and selling. When the Federal Reserve buys bonds from the market, what does it supply in return? When you buy something, what do you pay in return?
Interest.
No, when you buy something, you pay money, right? You pay money. So and this again is a simple context, demand and supply. If you have, this is the interest rate, for example, this is the interest rate, this is the quantity of money. If you want to lower interest rate, what would you do? You would increase the supply, you will shift the supply. So when the supply line is shifted outwards, that is by buying bonds, supplying funds in the market, what has happened to the interest rate? The quantity of money has increased and interest rates are lower now. This is the mechanism. Because the people demanding probably don't need as much money, but if there's free money available, they will go for extra money, but at a lower interest rate, and this mechanism ensures that interest rates drop in the economy. Okay, students online, did you see this little context? Yes, you're right, Quincy. That's exactly how it works. I think we are probably going a little off tangent to what we are discussing, but these are interesting discussions. I want to come back. I have another 30 slides to finish, so I'm going to move a little fast. Transfer of capital from savers to borrowers. There's a direct transfer. A corporation issues commercial paper to an insurance company. The money can transfer directly to corporation through an investment banking house. Example, an IPO, which is launched, or a seasoned equity offering, which is a subsequent offer of securities, or debt placement. Company sells securities to investors, banking house which then sells security to investors. And through financial intermediary, for example, individual deposits money in bank and gets certificate of deposit. Bank makes commercial loans to a company. Bank gets a note from the company. Cost of money. So when we talk about cost of money, we've already discussed what is the cost of money, the interest, and what is the cost of labor. I'm trying to test you on your economics as well. Wage, right? The wages that are paid for labor. So these are the two driving forces for production process, the cost of capital and cost of labor. What do we call the price or cost of equity capital? It's the cost of equity is required return, which is the dividend yield and capital gain. What is dividend yield? Dividend yield, if you recall, is the amount of dividend that's paid divided by the share price. And the capital gain is the increase in price from what you purchased and what you sold at. So that increase. It can also be a capital loss. It could be, because if you sell at a loss, it will be a capital loss. What four factors affect the cost of money? You have production opportunities. If you have several production opportunities, then providers of funds will have more options. They'll demand, more incentive to invest in your corporation. Time preference for consumption. Like we were discussing, Caleb mentioned, the longer projects would probably require more incentive for investors, because investors would have to give up their consumption for a longer time. For example, if I'm investing for 1 year, I may not demand as much of interest rate, but if I'm investing for 10 years, I may need more, compensation for that risk. Obviously, higher risk demands more return. Expected inflation. You want to be compensated for the rise of goods and services in the economy, the rise of price of goods and services in the economy, so that you don't lose the value of your investment when it's returned back to you. Any questions so far, students online or students in class? What economic conditions affect the cost of money? You've got the Federal Reserve policies, as we discussed. They target the market interest rates. For example, if the market interest rates are almost 0%, I can't go to a bank and say I need 5% return on my deposit. That's not going to happen. Budget deficits and surpluses, which the company probably will decide, with how much of dividend they want to pay for their investors. Level of business activity, recession or boom. In the boom time, obviously, you may have a higher cost of money, because investors would require more incentive for investing in your project. Recession, there'll be limited projects, so investors may even provide funds at a lower rate. International trade deficit, surpluses. again, if an economy is carrying a large international trade deficit, it has a chance for the devaluation of currency. Again, we're going into international economics. International trade deficit, what does that result in? It results in the current account of a country running a deficit. What is current account? It's a near-term account, within 1 year. And then for that, you probably have to get funding from government, government bonds. That would mean printing more money to fund that deficit. Printing more money means the currency will lose its value. In case of surpluses, it's the opposite effect. What international conditions affect the cost of money? Country risk depends on country's economic, political, and social environment. We've discussed that. Greece right now has a country risk. Exchange rate risk, non-dollar denominated investment value depends on what happens to exchange rates. Exchange rates affected by international trade deficits and surplus, as we just discussed. If a country is carrying a large trade deficit, more than likely the value of its currency is going to be devalued. Why doesn't it happen in the case of US? US carries a large trade deficit, but the US dollar goes up in value. Why doesn't it happen? Because the US is able to finance the debt by its bonds at a cheaper rate. We discussed that, right? So let's say, for example, a country like...
What happens in China and all these bondholders start to sell the bonds?
Why would they sell the bonds? This is a very interesting discussion. Why would China want to sell the bonds? And who will lose? Who will lose? Who will be the loser in the end? If China starts selling US bonds, US will lose, and China will also lose. The world will lose. So now we are tied in this global trade where we are all in it together. If I go down, you also go down. Dollar is strong, but irrespective of that, countries are moving towards, kind of a trade relationship where China needs US as much as US needs China. It's like if China starts selling bonds, obviously US economy will hit. And then what will happen to China? In short run, yes, it may collect dollars, but the dollar's value will go down. Because if the US credibility in the world market goes down, the dollar value will plummet. And China's holding will plummet. And then who will China sell to after this scenario? Their own manufacturing facilities will start to shut down, and their own economy will falter. So this is going to be a lose-lose situation. So, again, we have to think rationally in a very strategic manner as to what the actions could lead to. And Chinese will not do that. No country can afford to do that. So it's like saying, yes, I have this massive credit card, and the US will probably not do anything because the US has this massive unlimited spending credit card which it can keep borrowing from, because China, it's like a cyclical process. You have the US and you've got China on this end. China supplies goods to the US. US supplies dollars, and then China supplies the dollars to the US by buying bonds. So it's like a big, like an unlimited spending credit card. So it's a win-win situation. for both countries. And I think that's why China will never put US in that situation. But in long run, you never know. I mean, the fact that now Chinese have started to emphasize on bringing their own currency as an important currency in global trade, it may be a long-term strategic thinking for Chinese, but in short run, I don't think that would be a case. Relative inflation and interest rates, and then the country risk. We've discussed that with several examples. What two factors lead to exchange rate fluctuations? Changes in relative inflation will lead to changes in exchange rates, and an increase in country risk will also cause a country's currency to fall. We've been seeing that in recent example in the global economy. What's happening to currencies? Mostly Asian currencies have been, dropping in value. They've dropped in value by 20 to 30% in last 2 to 3 years. So what does that do to international trade for the U.S.? It makes the dollar stronger, and what does that do to a trader in the U.S.? We can buy more goods, but it'll be hard for us to export more goods. And the real reason Chinese, they started devaluing their own currency is because of the weak manufacturing indicators that were coming, for last couple of quarters, that their own manufacturing facilities were slowing down. Their own economy was being hurt because they're such a manufacturing intensive economy. Everything, is tied to manufacturing that's applied to global markets. So to make their products competitive, because other markets are also catching up. You've got India catching up, you've got South Africa, you've got Russia, you've got Brazil, you've got several of the other South Asian economies catching up. So to make their own products competitive in the world market, China themselves, they devalued their currency by 5 to 7%. It's like saying we are providing our goods at a sale of 5 to 7%. It's similar to that. What would that do? That would incentivize buying of Chinese goods, and that would spur their economy again. That's the idea. But it does have an impact because if, for example, a country does not have enough foreign exchange rate reserves, the perception can make their currency slide more than what they expect it to do. I mean, for example, if Chinese thought, well, we want to let our yuan slide 7% and not any more, how can they stop that? Again, there is no button to say after 7% we'll stop that, because it's market driven. The only way they can do it is by buying their own currency and keeping the value at that level. For that, they need foreign currency reserves, which Chinese have, abundant of foreign currency reserves. But some of the Asian countries don't. So if their currency starts sliding down, there is no way that they can hold that process by intervening in the market and start buying their own currency back to keep the value up. And that's what happened in the 1990s. That happened, with the South Asian currency crisis, when, Thailand, Malaysia, some of the other South Asian countries were impacted because they had run out of foreign currency reserves, and they couldn't stop the devaluation of their currency. And that's happening to Russia right now. Because of the embargo of trade, Russian economy is now running out of foreign currency reserves. So it has impacted their currency because the currency is sliding down, and they cannot intervene in the market to keep it at a level because they don't have enough reserves to buy back their currency. So the new trade, new weapons of modern warfare is not the weapons as we know. It's understanding of economics and finance. It's how these governments strategically try to intervene in the market. I mean, can US go to war with Russia in a conventional manner? That's going to lead to self-destruction, right? In this case, it's economic war, which is legal, and that is now hurting the Russian economy. So this way, we've seen Iran come to table to discuss and negotiate. Cuba is another example, and those have been able to be done because of the strategic planning and also the economic sanctions and embargo. I mean, those are some of the factors that if you read Wall Street Journal and other business newspapers, you'll get a better, deeper understanding of the facts. But let's keep discussing financial securities. If you had to summarize debt, examples are T-bills, CDs, Eurodollars, Fed funds. Capital markets are T-bonds. What's the difference between money market and capital market? Term structure, yes. What term? Length of time. Money market is market of assets which have a maturity of less than a year. Anything more than a year is capital markets. So these are short-term liquid markets, and these are the instruments, and capital markets are long-term markets, security markets. So these are the examples of debt, equity, and derivatives. Typical rate of return, as we've been discussing, the UST bills have the lowest, 0.41%. But again, these are from 2009. Comparisons, bankers' acceptances, 5.28, commercial paper, 0.28, negotiable CDs, 1.58, Eurodollars, 2.6. Again, based on perception, what each asset incur as a risk. Commercial loans tied to prime meaning the prime rate offered to the prime borrowers, or LIBOR. What is LIBOR? It's London Interbank Offer Rate, which is the rate at which banks would borrow funds from each other outside the US. Why would that be different from banks in the US borrowing dollars? How would the borrowing of dollars outside the US between two banks be different than borrowing of dollars within the US? Because in the US, banks have the backing of the Federal Reserve. If one bank fails, the Federal Reserve is there to honor the commitments of one bank. But outside the US, the central bank of the US will not come to the aid if one bank fails and it doesn't pay back its dollars that it had borrowed from another bank. So that's why the LIBOR always has a little bit more of interest rate when you compare to the local, the prime rate or the local rates, between the interbank borrowing rate. And that is something, Rich, that you have brought about the rate which is fixed between the borrowing of the banks. That's one of the monetary tools that the Fed uses to target the market interest rate. That is the interbank rate, which is set by the Federal Reserve. Other rates comparisons are US T-notes and T-bonds. T-notes are going to be, for a term relatively near term, and T-bonds are going to be long-term maturities. Mortgages, municipal bonds, corporate bonds, preferred stocks, common stocks, and we'll discuss all these in detail in chapters to follow. What are some financial institutions? You have commercial banks, investment banks, savings and loans, life insurance companies, mutual funds, pension funds, hedge funds, and private equity funds. These are all, those intermediaries we discussed, which package funds that will take from the savers onto the borrowers and vice versa. What are some types of markets? A market is a method of exchange, one asset, usually cash, for another asset. We've discussed this. We can have physical assets versus financial asset, spot versus future markets. What is a spot market? Current market, you walk into a market, you transact and you exit. Future market is you can transact or you can decide on transacting for a future date today at an agreed upon price, which is today, for an agreed upon quantity, price, and delivery at a future date. So these both are important markets because future markets would guide what's coming in future. So for example, if you look at the Dow Jones Industrial Average price for future, that is sort of a market benchmark rate. That's what market participants are thinking market is going to head in 6 months down the road or 1 year down the road. For example, if I ask you, do you think market is going to perform better than today or worse than today? What would your perception be? You're saying better. What about you? Hopefully better. What about you? You have no expectation. Saying probably not better. Again, it's a market, overall market, how a market as an average thinks, and that would be that future indicator. So we have Akshay saying better. Okay. Money versus capital markets, we have discussed primary versus secondary market. Primary market is a market where the securities are first issued, and the secondary markets are markets where once they're issued, they can be traded in organized exchange and other markets. So here we have primary versus secondary. Primary, new issue, that is the first issue. Key factors: issuer receives the proceeds from the sale. Secondary, existing owner sells to another party. And this is, the examples are the stock exchange where the stocks are sold over and over again. Issuing firm doesn't receive proceeds and is not directly involved because the owner of the stock would be involved at that stage. How are secondary markets organized? By location, you may have physical location exchanges, which are fast disappearing. Most locations are now going in, electronic, or exchanges are going electronic. For example, the only major stock exchange or a physical stock exchange is the New York Stock Exchange, the NYSE, and that too is now going electronic. Soon there'll be no physical exchange, just electronic, connected through computers, and that would be the primary mechanism of dealing. Which is the other major exchange in the US, which is all electronic? Which? CBOE, yes, that's for the Chicago Board of Exchange for commodities, but stock exchange. NASDAQ. NASDAQ is the one which is just an all electronic exchange. I mean, if you go to Times Square, you've got a building, a nice blue building on the left, which says NASDAQ, but there is no trade that's happening. It's all computers, people working for NASDAQ. That's who they are. All trades are happening electronic. But why did NASDAQ suddenly have the popularity as an exchange in the 80s or the 90s? Because if you compare the stocks, the kind of stocks which are listed on NASDAQ, they're more new sector related stocks, the IT firms, financials, biotech. Because New York Stock Exchange had very stringent rules, or still has stringent rules of listing in terms of volume, trade, and so forth. All these new companies which are coming on horizon, like Yahoo, Microsoft, Dell, IBM is pretty old, but the new ones, Google, they all opted for NASDAQ because it was easier to list. They had few stringent rules and regulations, so they could pass by. So ultimately, NASDAQ, benefited from that because they have all the financials, IT firms, biotech firms, which are frequently traded. IT firms, stocks, financials, they are very frequently traded. And how do these exchanges make money? By transaction costs. So more frequency of trade means more money for those exchanges. By the way that orders from buyers and sellers are matched, open outcry auction. If you saw one of the movies from the 80s where traders were just shouting and buying and selling, throwing paper, that's basically the outcry auction. Dealers, market makers. Why are dealers so important for an exchange? Liquidity in the market, exactly, because dealers are unlike brokers. Brokers they bring buyer and seller together and they create a market, for the transaction. But what do dealers do? Dealers hold inventory, like a car dealer. You can go to a car dealer and from their lot you can pick whatever you want to buy, or you can sell your old car back to a dealer. They'll buy it. Same thing with these stock market dealers. They're specialists who probably will have one or two stocks that they specialize in, and they stand ready to buy and sell even if nobody else will buy or sell in the market, and they provide that very important characteristic of liquidity in the market. Electronic communication networks, ECNs, that again is important because now we have computers or networks connected that create market orders. And what has that done? In last 10 to 15 years, if you see the kind of transaction costs, I remember in the late 1990s or 2000, I had just come as a grad student, and I would sit in office of my professor, and he would be looking at stocks through his newspaper. And if he had to buy or sell, he would call his broker on telephone, and then he would request buy or sell, and he would tell me each trade costs him $32 a trade. But over the years, because of online brokerage firms coming in and all these computer networks, the cost of trade has dramatically come down. I mean, you can buy or sell for less than $2 or $3. And that is instantaneously. You don't have to wait for your broker to confirm on telephone. You can see right in front of you a trade buy or trade selling or being purchased. So this has brought this interesting concept of rapid buying and selling. If you have some time, I would recommend to read a book called Flash Boys. Flash Boys. It's a very interesting concept of rapid buying and selling. So people are now buying and selling for a profit of a tenth of a cent, and they're making millions of dollars on that. We think, how does it make a difference of a cent or two up and down? But they enter in the market just before an order is placed, and they exit the market just before an order is placed by quickly buying and selling, so they can buy and sell at a margin of a tenth or a hundredth of a cent, and on any trade making $10,000 or $20,000, and they're probably doing hundreds of trades a day. So it's a very interesting read in case you have time to read. This is how the market is changing. Physical location versus computer telephone network. We've discussed physical locations. Exchanges are the New York Stock Exchange. MX is no longer in existence. That is now gone with NASDAQ, Chicago Board of Trade, Tokyo Stock Exchange, and even New York Stock Exchange will soon become an all-electronic exchange. Computer telephone is NASDAQ, government bonds market, foreign exchange markets. Types of orders, instructions on how a transaction is to be completed. You can have a market order, transact as quickly as possible at current price, Or you can have limit order where transact only if specific situation occurs. So you can tell your broker, or you can put that as a rule in your computer online transaction saying sell only if price goes above a certain price, or buy only if the price comes down to a certain price. Obviously, there's going to be a little more transaction cost for this specialized order. Auction markets, participants have a seat on exchange, meet face-to-face and place orders for themselves or for their clients. And these are the dealers, the market makers. For example, on the CBOT, New York Stock Exchange, and Amex is no longer there, is the only largest auction market for stocks. New York Stock Exchange is a modified auction with a specialist. Specialists we have discussed are the market makers, who are specialists. And they normally are these large investment banks, because it takes a lot of money to become a specialist. Imagine the volume of stocks that are traded, for some of the popular companies. Like, for example, Microsoft, on a given day, on average, will trade close to 3 to 4 million stocks a day. And if it costs $40 a share, that's 40 multiplied by 3 million. That's how much of fund we're talking about just for one day of transaction. So somebody with that much of funding backing would only be a large investment bank. Dealers market, they keep an inventory of stock like car dealers and place bid and ask advertisements, which are prices at which they're willing to buy and sell. Often many dealers for each stock, computerized quotation system keeps track of bid and ask prices, but does not automatically match buyers and sellers. So let me show you I think we do have some time, so I can show you something. Okay, what's happening here? Okay, students online, can you view the desktop that I'm sharing? I couldn't really share, just one single application. Let me open up Chrome. My computer upgraded to Windows 10, and this Edge is a little funny, so I'll just go back with Windows Chrome. It's been good and bad. Windows 10 is good and bad. I like the smooth transitions and some of the features it has, but the Edge needs work because it doesn't really work with many Java-related, applets. So Blackboard doesn't really work as well as it should. So I'm here at finance.yahoo.com. I hope everybody can view this browser. I mean, Windows 7, I believe, is good enough. But let's go to the Microsoft MSFT. So here's the stock quote for Microsoft. What I wanted to show you was the bid-ask spread. Bid is the price at which the dealer is willing to buy, and ask is the price at which the dealer is willing to sell. So you can see there's a difference between bid and ask. That's the dealer profit. They're probably going to make a little bit profit for the trouble. Another thing I wanted to show you was the volume. Look at the volume. Average volume is, I was wrong. I mean, I thought it was 3 million, but the average volume per day is about 33 million. So if you're transacting 33 million stocks every day on average, multiply that with 41.82. That's the kind of money these investment, banks who got specialist seats would have to have in reserve for daily transaction. I mean, because the clearing takes 1 or 2 days, so the money may not come to them for 1 or 2 days. In the meantime, these banks have to still clear the transaction. So other things here, we'll discuss when we get to the chapter. You look at the obviously the price at which it sold last, that is up and down from the last comparable. After hours, because it's an electronic exchange, the transactions would still keep happening, even though the stock exchange closed at 4 p.m. Eastern Time. It's listed at NASDAQ. So the after hours will still keep happening as it happened, and this would clear the next morning when the stock exchange again opens. And then you have other things. Beta is proximity of the stock price to the overall market. You got the days range, the low and high for today, 52 week in a year, what was the low and high. Volume is today's volume, and then average is on average. And the numbers really are important to compare, because if the average volume is 33 million and today transactions happen for 49 million, then something must be happening with Microsoft company, because this is a little bit out of the line. Normally the number should be close to the average number, but now you have almost 16 million more stocks traded today for Microsoft. So there must be something good or bad happening for Microsoft. Which one? Yeah, market is down again 2.8%, which is not so good. But anyway, we'll discuss that in chapters to follow. So we've discussed this. Electronic communication networks, again, we've discussed. These are computerized systems. There's some examples here, and the benefit is because there is no, brick and mortar type, buildings to maintain, no real, salespeople to hire. They can pass on the benefits to consumers, which is by low cost to transact. Over the counter, in the old days, securities were kept in a safe behind the counter and passed over the counter when they were sold. Now the OTC market is equivalent of a computer bulletin board, for example, NASDAQ Pink Sheet. Pink Sheets are normally for stocks which have been delisted. Once they don't qualify for the listing regulations, they're delisted, but the company still have stocks, and they have to be traded, and they're done on this over-the-counter Pink Sheet. For example, when General Motors, went down in value, it was delisted, and it had to go on over-the-counter, and obviously after bankruptcy, it came back again. This allows potential buyers and sellers to post an offer, which doesn't have dealers, and it has very poor liquidity. You can think of these companies which have been delisted from the stock market. Okay, we got home mortgages before savings and loans. Now we're coming to the whole genesis of the recent financial crisis. The problem if an individual investor tried to lend money to an aspiring homeowner, individual investor might not have enough money to fund an entire home. We have discussed this. Or individual investor might not be in a good position to evaluate the risk of potential homeowner. I mean, even if I have money available with me, I may not be an expert to really decide how much of interest rate I should charge given the risk of the borrower. Individual investors might have difficulty collecting mortgage payment. I mean, what if I don't get my funds back? Am I going to go and ask for funds every month? I mean, I may not have the legal framework to collect my funds back. That's why we have this, the financial institutions which are sort of intermediary between the savers and the borrowers. So savings and loans before securitization. Savings and loan associations solve the problems faced by individual investors. Savings and loans pool deposits from many investors. Savings and loans develop expertise in evaluating the risk of borrowers, and savings and loans have legal resources to collect payments from borrowers. I mean, if you're wondering what we're talking, I'll just give you a brief summary in a quick 5-minute discussion. So think of savings and loans as this cooperative of individuals getting together to save and borrow funds, like a bank, a mini bank. Now you have several savers who will contribute funds, from various source. For example, somebody may have current account, somebody may have savings account, somebody may have certificate of deposit. And then what is the main revenue for a bank? Or used to be, traditionally, the loans, interest, collection from the loans. That would be the main revenue. So loans, exactly, you're right. The banks would then lend the money which has been pooled together for various amounts and for various term maturities to borrowers. So, for example, the bank makes mortgages to various borrowers. But what is a flaw in this type of a system? What's going to happen very soon? Look at the difference of term maturities. Usually when I deposit funds in a bank account, my requirements is not 30 years. I probably may need my funds back in a 1 year or 2 year term. But what about, on the other hand, the mortgage owners, the holders? They probably are going to borrow funds for 30 years, and this doesn't match. So soon what happened was savings and loans ran out of new funds to make loans. This would have worked out okay because, as the homeowners provided the interest to the bank, these were transferred over to the savers, right? But we know interest rates keep going up and down. So, for example, if I have an account with this XYZ bank and I am being given 2%, and after 5 years, market interest rates go up to 5%. So my expectation would be my deposit rates should also go up. Otherwise, what am I going to do? I'm going to withdraw my funds, close my bank account, and move to another bank which is going to give me a higher interest rate. And what would that do to this bank if there are going to be mass withdrawals? There'll be a run on the bank because these borrowers will take their own time to return the funds back. New depositors will only come to the bank if the bank can match the current market interest rate, and that soon is going to bring the bank in a situation where it's spending more to retain its customers than what it's collecting as revenue. And that would mean the bank will soon have a run on its holdings. And this happened in the 1980s, and obviously this was a systematic issue because there were several savings and loans and they all defaulted. And then they had to be bailed out. So a solution to this problem was thought over, which was known as securitization. What is securitization? Now, instead, think of this situation where you have a bank, you got depositors providing funds, and there are borrowers who are borrowing funds for mortgages. Now, as soon as bank knows, that it has made enough loans, what they do is they will package these loans as securities and they will sell them off their books to investors. Why would investors want to buy these securities? Because they are looking for fixed income. Fixed income because mortgages will provide fixed income. Mortgages will provide monthly payments, and that will be something that a lot of investors want. I mean, retirees or anybody who's interested in getting a fixed income, insurance companies. Or you would think because they're tied to an underlying security which is quite secure. I mean, home is a physical asset. If the real estate is tied to a loan, you would think it's a safe investment. Stocks are risky, but if you have a home which is tied to investment, you would think it's safe. So you had investors, individual investors, all these insurance companies, even foreign investors were buying into these securities because once they were securitized, they were packaged together. Third parties, rating agencies rated these securities, such as the Moody's or the Standard & Poor's, and they were giving them top rating, AAA. When you provide AAA, that means it's almost zero default. I would look at this AAA and say if Moody's has recommended that this will not default, I'm probably going to invest in this. So what does the securitization do? As soon as the banks sell them off their books, what do they get from investors? They again get cash infusion because now they get cash back and the banks can make more loans. And banks were making money from processing fees, for making loans. You got processing fee, home, the loan origination fee, 10 different type of fees. That was becoming a bigger revenue for the banks rather than the interest payment coming from these mortgages. So banks were interested in making this securitization process as fast as possible. And over a period of time, what happened? The rules were being relaxed. For any new home loan being now underwritten, you've got documentation to provide, like income proof, W-2s and other things. So banks were literally just accepting anything. So for example, if somebody who probably is to be provided a loan of $100,000 were being offered loans for $500,000, for new home loans. And like we discussed, because of the bubble in the real estate market, there was a demand for mortgages. So the banks literally decided, well, since we are not having the risk, because as soon as we made the loans, we are packaging them and we are selling them off our books, and we're getting cash in return. And most of these loans were what? They were federal agency insured, the FHA, for new home loans and for special type of loans. So buyers of these loans were also not concerned because they knew that these loans would be backed by the FHA. So it's insured. Even if they default, they will take care of these underlying securities. So that's why, there was a complex network of due diligence not done by the banks. The investors who were buying these securities, they were buying thinking these are backed by FHA, so they won't be in any trouble. But ultimately what happened? Game over came when the market interest rates started going up, because most of the subprime, the real trouble started with subprime mortgages. Subprime mortgages are mortgages made for not, you can say, prime credit owning customers. So with less than perfect credit. These customers were sometimes deceived because they were offered loans on a teaser rate with a variable rate. In the initial part of the loan, they had loans which were tied to low interest rates, and then suddenly there's spike after 2 years, or 1 year or 1.5 years after the teaser rate had expired. But this was not disclosed to the borrower, because as a borrower you would say, okay, how much do I have to pay monthly? If they were told, okay, you have to pay $1,200 a month, but not informed that this will jump after a year to $1,800 or $2,000. So this subprime mortgage, thing started the domino effect for the collapse of the housing bubble, because as customers couldn't repay the mortgages, what happened? The pass-through didn't happen, because the banks were also acting as pass-through agents. So if I have a mortgage and if I fail to pay, the money doesn't transfer from bank to the current owners of those securities. So that thing stopped, and as more and more of these things stopped, because every securities, when they are created, the creators would, they would assume certain level of risk. They will say, well, out of 100 mortgages, maybe 10 will default or 5 will default. They will, have a room for that, 5 or 10 defaults. But when you have 50 defaults, that is too much of a risk. When insurance companies write policies, they assume that from 1,000 policies, maybe 10 will have accidents or 100 will have accidents, and we'll have to pay for the damages. But the 90 or the rest of the premiums that they're collecting, they will not have any accidents. And that's how that tool works, because you've got insurance for 100 people and 10 will claim, so 90 will pay for the 10 which are taking the claim. But in this process, when the default started happening, that led to people now selling off their properties, and the prices started going down to an extent where now you had a situation, for example, if you on book have a loan of, let's say, $200,000, your property in market is only worth $50,000. So why would you carry on a loan for $200,000 for a property that's only worth $50,000? That doesn't make financial sense. Yes, ethically, you should carry on because you made a commitment to carry on the loan. But financially, this project is not viable. So many people just walked off their property. They said, well, here are the keys. We're just walking off the property. You can take it. And banks were left with all these unsold properties, and that again created more trouble, because now banks were still in process of holding a large share of these loans which went bad, because they were still in, some banks were still in process of making securitization, some had made, because if you think about of a bank of the size of Bank of America, it may have billions of dollars of mortgages on its books which have not been sold off as yet. And when those default, on asset side, like I was discussing, on asset side, yes, you have those billions of dollars worth of properties on the balance sheet. That's your asset. But in real sense, is cash flowing in? No, there's no cash coming in. So that's the reason why we had the bailout, where cash infusion had to take place for the banks for liquidity. So that could give banks the time to dispose of the properties. But again, the properties have to be sold off, on like pennies on the dollar, because we hear about multi-million-dollar homes being sold for $70,000, $80,000, especially in Florida and California and Texas. I mean, that was the reality. So is securitization bad? No, securitization is a good concept, because it lets now bank have cash immediately to make more loans at the current prevailing interest rate. Because savings and loan had problem because they were not able to turn around their loans at the current prevailing interest rate. In this case, banks can sell off the mortgages from their books, and with the new money that comes in, can make new loans at the current prevailing interest rate. And that would have worked fine. And for market participants, they get all these new securities to invest in that will provide them with fixed income security. And mortgage owners obviously will get loans, for buying home properties. That would have worked fine in a theoretically ethical environment. But when you have now managers, at every level who are thinking about their own interest, because they were getting a commission, the loan underwriters would get commission, so they were not interested in checking or verifying documents of income proof or other proof. They just wanted to close the loan as soon as possible so that they can make their commission and then move on to the next loan. The banks were encouraging underwriting as fast as possible, because banks were making money by all the loan fees, and then once they sold the securities of their books, they would get commission from or the fees from the buying agents of the securities. So they couldn't really handle the kind of loans they were making. Market was asking, make more loans, we need more securities. And banks were making money, agents were making money, real estate agents were making money. Some of the market participants who were invested in real estate, they made money. The ones who got out of the market fast made money. The ones who couldn't get out lost money, because real estate is something that you personally feel attached to. For example, if you buy a home at $200,000, it's very hard to sell at a loss. I mean, this again is human psychology. For example, let's say you have this beautiful, nice bag, you spent $100 buying that bag. Even though you used it, would you sell it at $25? Probably not, because it's called human anchoring. Your mind anchoring. It's got human psychology involved in it. That I bought this at $100, no matter what, I'm not taking anything less than $100. So there were a lot of sellers in the market who did not realize to what the market was headed. And it's hindsight, even though we think about it, hindsight, we're still going into the same process. I mean, what if the market still continues to go down? Stockholders right now, they're not selling their portfolio. They're thinking the stock market will come back. And this is exactly what happened in 2007, 2008. Retirement portfolios got wiped out because investors thought, well, I'm looking at long term. Market is coming down, but it will come back. I'm not selling at a loss. So we have all these different aspects that are important to understand. Finance is not just mathematics, it's also human psychology. If you really have to be successful in this field. you have to also understand human psychology. So, like I said, SLN, before securitization, SNLs pooled deposits from many investors. SNLs developed expertise in evaluating risk of borrowers and had legal resources to collect payments from borrowers. And then, all this discussion I just made about the limitation in the amount of mortgages, they couldn't really repackage for the current market interest rates. So taxpayers had to come to rescue for SNLs, which were almost bankrupt in 1980s. So then you had the securitization in home mortgage industry, is the pools which were created and sell the pools to other organizations such as Fannie Mae. After selling a pool, SNLs have funds to make new home loans. Risk is shifted to Fannie Mae because you're shifting risk from your books to the buying agency. Risk hasn't disappeared, it has simply been shifted to Fannie Mae, but Fannie Mae doesn't keep the mortgages, it in turn sells to other investors. So it wasn't a chain of 2 or 3 investors. In certain cases, it was 10, 15, 20 resales and resales. That's why, when there was this whole debate about providing documents for ownership, because the ultimate buyer couldn't prove where the real property is, because there was so much of cross documentation. There were billions of dollars of properties, where the real ownership is, where it's coming from, where the money is going. It was all a mix-up. So this is called securitization, since new securities have been created based on original securities. Collateralized debt obligations, CDOs, Fannie Mae and others such as investment banks can split mortgage pools into special securities. Some securities might pay investors only the mortgage interest. So depending on how these are created, they can have different types of securities made. Risk of basic mortgage is parceled out to those investors who want that type of risk and potential return that goes with it. So there are buyers for all types of securities. Other assets can be securitized like car loans, student loans, credit card balances. The dark side of securitization, which I've already explained, I think you can read through this, the commission and everything, and this again. One thing which is even interesting is the credit default swap. The credit default swap is again a very interesting financial security. It's like a insurance premium that you can purchase to safeguard your investment against risk of loss of value. And since this is not organized, you don't have to report this on an organized exchange, but it's a legal document that can be made between an insurance company or a bank or insurance company that's willing to write a credit default swap. So I basically, let's say for example, if I feel that I may lose value on my portfolio, I can go to a bank or to a company that's willing to write a credit default swap and say, provide me with an insurance against the loss of value of this investment. And in return, they would ask for a premium like an insurance. So you can call it as a contradicting their own customer interest. They were literally like companies like Goldman Sachs. Goldman Sachs had this funny thing of knowing that these securities will fall, they will collapse, yet they were selling them to their customers because they knew that they are subprime mortgaged and soon they will default, yet they were selling them to their customers and selling them as great securities because these are AAA rated. And on the other hand, since they knew they were going to be collapsing, they were writing credit default swap against those securities. So they were betting that these securities will collapse. So they were going to make money on both ends. This is the irony of the financial system. That's why basically, again, yes, this is a derivative, but I just wanted to emphasize, and in some of the emails that were made, subpoenaed and they were made public, and in the legal proceedings they were laughing at their customers that this person is probably going to lose money, and we know that we're going to make a lot of money. So they were literally writing such emails. And with credit default swap, they were betting that these securities will fall. So this is conflict of interest. As an advisor, my role would be to advise my client, in the best possible manner. If I know that something is against the interest of my client, and yet I'm selling it, and then on top of it, I'm also buying a position which is against that position so that I can profit from his loss, that's totally conflict of interest. And that's what Goldman Sachs was doing. And then they obviously had to settle for the Department of Justice's, they had to make settlements, but ultimately taxpayers again had to bail out the banks, and there was a lot of loss of funds and everything, which provided the argument about the Wall Street versus the Main Street, how the Wall Street has taken all the benefits from the recent financial crisis, whereas the brunt of the recent financial crisis had to be faced by regular folks because of loss of there was a lot of unemployment, recession, people lost homes, values, their retirement portfolio, a lot of investment. So overall, the risks have still not gone away. I mean, a lot of talk had gone in terms of protecting investors. Some has been achieved, but most of it still remains. And that obviously will happen because of legislation. I think that pretty much, again, brings us to the end of chapter. I think I've finished 50 slides. I'm at a point where I need a glass of water now because I've spoken so much. But anyway, any questions at this point? I hope that this is a very interesting start to a semester ahead. It gave you sort of a precursor to what we'll be discussing over the semester. This is just a start. This is a very basic start. And from next chapter onwards, we'll be discussing more into the concrete areas of this basic argument that we've had in this class. If there are no other questions at this point, I'm going to be posting your homework assignment on Blackboard, and that will be coming from the textbook. So I'll mention what questions to work on. The other thing would be a discussion post. I'll post a discussion post that you can participate in. The details are discussed in the first session. So those are the two main things, and you have to start working on your video case studies. And that will give you further insight into what happened in the recent financial crisis. Those are going to be very interesting video case studies. So those three things you should start working on. I am going to give some additional time for students who have just joined, like Caleb, you've joined recently, so you may take some time to buy the textbook, and so I may give you some more time for this first assignment, but from the next assignment onward, I would assume everybody's on board, so we'll have a regular submission timeline. All right? Any questions at this point? No? Okay, then that's all for the class this evening. Thank you so much for joining. I'll see you next week, Tuesday, and that is going to be the 8th, because next week, Monday is a holiday because of, I think we have a Labor Day. So next Monday is a holiday, but Tuesday is a working day, so we'll have a class next Tuesday. Thank you for joining in, and I'm signing off from Natchez campus. Look out for that assignment on Black